Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about ContextLogic. So, ContextLogic is a e-commerce platform, and it has meaningfully sold off in 2021. So, I'm going to go through and try and unpick some of its underlying prospects, and I'm going to note that yes, I that one of the things that kind of puts me off here is that the logistics business makes up about 40% of the underlying business. So we're going to go through that. We're going to discuss its profit margins. Finally, we're going to talk about its valuation. So let me just jump right in. So here's the thing, right? The stock is down substantially in the past 6 months. You can see here negative 65%. In and of itself, that is not a huge problem. Many stocks are down in 21. I mean, that is not apart from a very few select number of stocks that I follow, most stocks that I see around are down. So that's not a big reason for you to kind of, if you're a shareholder here, for you to kind of throw in the towel. The fact that it's December and December is everyone sells for tax reasons, it's also not a reason for you to sell the stock. So these are kind of outside of the fundamental reasons for the stock to be down, and those are not the reason. The reasons why I believe that this stock should be avoided is because of its fundamental prospects. So I'm going to go through that and hopefully offer you some insights. So revenue growth rates, as you can see here for Q3 21, are down 39% year over year. Okay, so it was supposed to be like, what do they call themselves? They call themselves the fastest growing global e-commerce platform. And yeah, I mean, that doesn't translate there. I mean, fastest growing and negative 39% year over year doesn't, tally up. The other thing that I want to highlight, they don't offer you any particular guidance for Q4, but they do say that they expect revenues for Q4 to be lower than they were for Q3. Now, let's just let's say that they're lowballing estimates to kind of positively surprise everyone. Let's say that when we look back to Q3, Q3 was 368 million in revenues, okay? 368 million. So if we take that number, 368 million, and compared to last year's Q4 where they had 798, that still implies that the revenues are going to be down 55% year over year for Q4. So that poses a bit of a problem. That clearly doesn't show that a company that's one of the fastest growing anything. Um, Now, what does it actually do? So the idea behind ContextLogic is that it's going to give consumers an affordable way to do e-commerce and entertainment. Okay, so that's the idea. It uses data insights to drive discovery. So they put out this fact that they say that 70% of its sales through its platforms does not involve a search query. It's just something that's personalized and surfaces to the individual user. So it's able to drive personalization, and that's really the key here, how it uses data to drive that. But if you think about it, if you just step back and you think about the business model, it's a bit like eBay, right? It's a two-sided marketplace. So you have a growth in users, that's going to drive a growth in merchants. So these two sides together drives GMV. So if you see that, you see the amount of transactions going through this platform, that's clearly a good sign. But as I say in all my videos, or all my articles, follow the customer growth or the user growth. If customers are rapidly increasing, irrespective of what the share price is doing, that's a good sign. If you see a large spike, try and understand what's behind that. Okay. On the other side of the equation, if you see users growing, declining by 40%, as you can see here in the screen, 40% year over year, that's not a good sign. I mean, if you're a two-sided marketplace and one side is falling off, I mean, it's difficult to get behind that. Now, one more thing that I did highlight. So you can see here in the screen, 60% of the business comes from its marketplace revenues. 40% comes from its logistics business. Now, just remember that 40% of the business is logistics driven. Now, let's talk about one of the best logistics businesses in the world. Let's talk about Amazon. Okay, so Amazon, if you look at Amazon right now, its profit margins right now are not that great. But keep in mind that Amazon's business model is predominantly driven at the bottom line by its AWS segment. Okay, so you've got AWS is really the crown jewel that's really like funding everything. And also keep in mind that Amazon's advertising business is the third biggest advertising business in the world after Google and Facebook. So that's obviously a very high margin business, no questions about it. So with that in mind, I mean, even if you look at that, Amazon's profitability isn't that attractive. So you have a business that is very much has a lot of scale, and its logistic business is going to be really, really razor thin. So with that in mind, how is it possible for Context Logic to have compelling margins on its logistics segment? It just doesn't make much sense here. Um, Now, one thing that I wanted to highlight is that when you look at it, right? So if you see here on the screen, for the 9 months ending 2021, they burned through 900 million of cash flows. So they made approximately 1.8 billion in revenues, and they burned through 900 million in cash flows. So the way to think about it is they make $1 in revenues, but they have to burn through $1.50 or $1.50 of cash. It doesn't make much sense. That's not a business that's going to be around for very long if you keep burning through at that rate. Now, on the positive side, they do have 1.1 billion of cash on this balance sheet. They have virtually no debt and no borrowings under the revolver. So all that, clearly they have a bit of staying power. But they do. You have to think that this is just 9 months of the year. Still got another quarter, and the Q4 is guided to be unprofitable. So all that combined, they're probably going to burn for 1 billion of cash in this year. So it's difficult to kind of see how this business is going to be, meaningfully turning this around. Now, bear in mind that there are a few lawsuits outstanding against the company, and I've given no consideration for that. So that's just something that I wanted to put out there. Now, the stock right now is priced at 1x forward sales. Now, I understand that earlier this year, the stock was priced at 10x forward sales. So just because it's priced at 1x forward sales doesn't mean necessarily that it's an undervalued stock, because there are many e-commerce players there that are growing, free cash flow generative, also priced at 1x forward sales. So I'll give you an example. So JD.com is a Chinese retailer. It's also growing at approximately 20% CAGR, generating very strong free cash flow, unquestionably strong free cash flow, and it's priced at 0.7x forward sales. So why would you pay more for something that is declining? This doesn't make a lot of sense, declining in terms of revenue growth rates. So I didn't want to kind of be the doom and gloom guy, but if you think about it, right? So I tried to put out an insightful, objective, earnest, and practical article to kind of show you that cheap stocks can always get cheaper. And I hope you found this useful. And yeah, so if you want to find out what kind of names I'm checking out right now, don't forget to check out my marketplace. It's called Deep Value Returns. You can see what other people said, check out my reviews, and I help you become a better investor, help you think through your portfolio. Okay, thank you so much for listening. Bye bye.